In a quiet office in Tokyo right now, a pension fund manager you will never meet is making a decision that will likely affect your mortgage rate before the year is over. He has never seen your house, he does not know your name, and he may have more influence over what you pay to borrow money than the people whose faces appear on financial news every single night. The biggest risk to your finances right now is not the headline grabbing the most attention this week. It is not whatever is trending on social media about the economy. It is something so unglamorous that financial media genuinely struggles to turn it into a compelling thumbnail. But the signs are everywhere if you know where to look. Mortgage rates that refuse to fall the way everyone expected. Markets that move sharply on days with no obvious news. The answer to both of those things is not sitting in Washington. It is sitting in Tokyo, inside one of the most boring financial instruments on the planet. I am Zane, and I think about this more than is probably healthy for one person. If you stay with me for the next 25 minutes, you will understand a mechanism that has quietly shaped your mortgage rate, your stock portfolio, and your retirement account for 30 years without you ever knowing it existed. Subscribe right now before we start, because the threat nobody is watching is always the one that arrives first, and this channel exists specifically to help you see it coming. Where this actually begins. To understand why decisions made on the other side of the planet affect what you pay to borrow money, we need to go back to the early 1990s. Japan, at that time, had one of the hottest economies on Earth. Then its asset bubble burst. Real estate collapsed, stocks collapsed. Japan entered what became known as the Lost Decades, an extended period of economic stagnation with minimal growth, minimal inflation, and stagnant wages. In response, Japan's central bank did what central banks do when conventional tools stop working. It cut rates to zero. When zero failed to revive growth, it pushed rates below zero. When negative rates still weren't enough, it introduced a policy called yield curve control, essentially a promise that the central bank would cap long-term interest rates regardless of broader market pressure. In practical terms, Japan did not just lower interest rates, it put them into an extended medical coma and stood guard over the bed for 30 decades. This decision, made primarily for domestic reasons, quietly built much of the financial world you're standing in today. The trade that quietly ran the world. Consider a pension fund manager in his 50s who has spent his entire career managing money for a large Japanese pension fund. His responsibility is straightforward but unforgiving. Millions of ordinary retirees depend on that fund to pay out reliably year after year. His own government's bonds, historically the safest asset he could buy, were paying him essentially nothing because of the near-zero rate policy. He faced two options: accept near-zero returns and explain to retirees why their pension was not growing, or take the money somewhere it would actually generate a return. Here's the move that quietly shaped global finance for 3 decades. He would borrow money in Japanese yen nearly free because of the near-zero rate policy, convert that borrowed yen into US dollars, purchase US Treasury bonds paying 4 or 5%, pocket the difference between what he paid to borrow and what he earned on the investment. This is known as the yen carry trade. Borrow where money's cheap, invest where money pays, capture the spread. Now, imagine not just one pension manager, but thousands of pension funds, insurance companies, banks, and hedge funds executing the exact same strategy simultaneously across 3 decades. Estimates of the total scale of this trade at its peak run into the trillions of dollars. A significant portion of the global search for investment returns, the dynamic that helped fuel cheap borrowing and elevated asset prices worldwide, was financed by capital that originated in Tokyo. And this entire arrangement rested on a single assumption: that Japanese interest rates would remain near zero indefinitely. In 2024, that assumption broke. After 30 years of trying to generate inflation, Japan finally got what it had been chasing. Prices began rising meaningfully. A central bank cannot maintain near-zero rates indefinitely while inflation erodes the purchasing power of its citizens. In 2024, Japan's central bank ended its yield curve control policy and raised interest rates for the first time in 17 years. It raised rates again and again. By 2026, Japan's policy rate is approximately 1%. That figure sounds modest by American standards. For Japan, it represents a 30-year high, a structural shift after decades of near-zero conditions. The moment Japan began raising rates, the economics underlying the entire carry trade flipped. Borrowing in yen was no longer nearly free. Currency risk became more expensive to hedge. The previously attractive spread between cheap yen borrowing and treasury yields began compressing. The free money was no longer free. And when free money stops being free, capital doesn't quietly and gradually reposition. It moves rapidly, all at once, as participants race to exit the same position simultaneously.
The preview nobody fully understood. On August 5, 2024, the world got a preview of exactly what that unwinding looks like. Japan's central bank had recently raised rates. A weaker-than-expected American jobs report landed on the same day. The yen strengthened sharply and unexpectedly. For anyone holding the carry trade, borrowed in yen, invested in dollar assets, a rapidly strengthening yen is a serious problem because the loan suddenly costs more to repay in real terms. Participants across the trade attempted to unwind simultaneously. Japan's stock market fell approximately 12% in a single trading day, its worst single-day decline since 1987. Worse than anything experienced during the 2008 financial crisis. Worse than the pandemic crash. Trillions of dollars in global market value were erased within roughly 72 hours. American markets were pulled down alongside it. For several days, it genuinely felt like a serious crisis was unfolding. Then, just as quickly, markets stabilized. Attention moved on to other stories. But that event was not an isolated incident. It was a preview of something larger and considerably slower moving underneath the surface. The word that matters most. Here is the single most important concept in this entire script: repatriation. After 30 years of Japanese capital flowing outward in search of returns unavailable at home, that capital is beginning to turn around and return to Japan. This makes complete sense from the perspective of a Japanese pension manager. For 3 decades, generating any meaningful return required looking abroad. Now, Japanese government bonds finally offer a genuine yield, without currency risk, without borrowing costs, without the complexity of the carry trade structure. Why would that money continue to remain parked in American assets when comparable returns are now available at home with considerably less risk? This is the mechanism that connects a decision made in Tokyo to the mortgage rate you are quoted next month. When Japanese institutional money begins returning home in meaningful volume, 2 significant things happen simultaneously. Japanese government bonds, particularly long-dated 30- and 40-year bonds, see yields rise to levels not seen in decades as domestic demand increases. And the United States quietly loses one of its most reliable foreign customers. Why this reaches your mortgage? Japan has been the single largest foreign holder of American government debt for an extended period. Not China, Japan. For decades, Japanese institutional investors provided dependable, consistent demand for U.S. Treasury securities, absorbing enormous volumes of American government debt issuance year after year. That demand is beginning to soften. Beginning in 2025, there were multiple periods during which Japanese investors became net sellers of foreign bonds rather than consistent buyers, a shift that market participants and analysts have been watching closely. Meanwhile, the long-dated Japanese government bonds mentioned earlier have been posting yields not seen in decades as domestic buyers now require higher compensation to hold them. Why does a single category of buyer pulling back matter to your personal finances? Because the bond market functions as the foundational pricing mechanism for nearly every other financial asset. The yield on long-term government debt sets the baseline risk-free rate that influences how stocks, real estate, and virtually every borrowing cost in the economy get priced. When the supply and demand balance for that debt shifts meaningfully, a recognizable set of symptoms tends to follow. Rising long-term rates, currency volatility, and increased demand for alternative stores of value. What the Federal Reserve actually controls. Most public attention focuses intensely on the Federal Reserve and its interest rate decisions. But the Federal Reserve directly controls only short-term interest rates, the overnight lending rate between banks. Long-term rates, the 10-year, 20-year, and 30-year Treasury yields that actually determine mortgage rates and corporate borrowing costs, are primarily set by something far less dramatic and considerably more powerful. Basic supply and demand. How much government debt is being issued and how many buyers want to purchase it. This is the lever that actually matters and deserves far more attention than it typically receives. The supply side of this equation is substantial. The United States is currently running annual deficits in the range of $1 to $2 trillion. Total national debt has surpassed $37 trillion. In 2025, the final major credit rating agency that still gave the United States a perfect credit rating downgraded it for the first time in over a century. Combine a rapidly growing supply of debt that needs to be sold with one of the most reliable historical buyers gradually stepping back, and the resolution is straightforward. To attract new buyers when demand softens, yields must rise. The 30-year Treasury yield currently sits at around 5%, a level that would have seemed unusual just a few years ago.
How this reaches into your actual life. Consider stocks first. When analysts determine what a company is worth, they project future profits and discount them back to present value using long-term interest rates. When those rates rise, the math automatically reduces what future earnings are worth in today's dollars. This means stock prices can decline even when a company's underlying business performance remains strong, simply because the discount rate used to value those future earnings has shifted. Now consider your mortgage directly. Mortgage rates move closely in tandem with the 10-year Treasury yield. If that yield does not decline meaningfully because demand from large institutional buyers like Japanese pension funds is softening, mortgage rates will not decline meaningfully either. This explains a frustrating reality many homeowners are currently experiencing. If you purchased a home at a relatively high rate and have been waiting for rates to drop significantly so you can refinance, that relief may not be coming as quickly or as substantially as widely expected, because the demand picture for the debt that prices your mortgage has structurally shifted. The relief many people are waiting for is not primarily being decided by domestic monetary policy. It is connected to decisions being made by institutional investors on the other side of the world. This extends to corporations as well. During the period of historically low rates, companies borrowed extensively at very favorable terms. A significant volume of that corporate and commercial real estate debt is now reaching maturity and must be refinanced at today's considerably higher rates. When refinancing becomes more expensive, companies respond by pulling back, hiring less, investing less, taking fewer risks. Credit functions as the circulatory system of the broader economy, and the long end of the yield curve effectively determines its pressure. The honest caveat. Zane wants to be fair about the other side of this story because this is not intended as alarmism. Central bank policy, particularly in Japan, tends to move extremely gradually. Japan still holds an enormous quantity of American debt, and it is not liquidating it rapidly. It is entirely plausible that this entire dynamic plays out as a slow, gradual shift over many years rather than a sudden, dramatic event, slow enough that it may not be noticeable on any single day. That gradual scenario is arguably the most likely outcome. But here is the important nuance about a slow structural shift. The direction matters more than the speed. A buyer that reliably showed up every single year for 3 decades is gradually becoming a less consistent, more occasional buyer. Once that kind of structural shift becomes established, it tends not to reverse simply because reversing would be convenient. Even the calm, gradual version of this story likely concludes in the same place. The cost of borrowing money may remain structurally higher than many people became accustomed to during the era of historically low rates that defined the previous decade. Why this story receives relatively little mainstream financial media attention. And the reason is straightforward. It doesn't generate engagement easily. A phrase like cross-currency carry trade unwind and Japanese institutional repatriation does not perform well in a 30-second video clip. It requires patience and context that does not fit neatly into the attention economy that drives most financial content. Instead, the broader narrative tends to get simplified into a comforting but incomplete story that central banks will cut rates and conditions will normalize, that liquidity always eventually returns, that someone, somewhere, will always show up to purchase American debt regardless of how much is issued. That narrative has historically been mostly true. It has never been guaranteed. If the largest reliable foreign buyer of American debt continues stepping back, global liquidity tightens. Liquidity functions like oxygen in financial markets, invisible until it becomes scarce, at which point its absence becomes immediately apparent everywhere simultaneously. And when that tightening occurs, it doesn't affect one isolated market. It affects the price of borrowed money across the entire economy simultaneously: stocks, mortgages, employment, and retirement accounts. Who actually experiences this? The institutions that participate in these large capital flows tend to be insulated from the consequences. The people who experience the real impact are typically not the people making the underlying decisions. It is the family that finally saved enough for a down payment and finds the monthly payment no longer comfortably fits their budget. It is the small business owner whose line of credit quietly becomes more expensive overnight. It is the person several years from retirement watching their account experience volatility that no single headline adequately explains. The bond market does not announce its decisions loudly. It doesn't need to. It simply repriced the cost of money for everyone simultaneously and moves on. Drop a comment right now and tell me, had you heard about the yen carry trade before this video? Or is this completely new information for you? I genuinely want to know how many people are encountering this for the first time, because understanding it puts you ahead of most financial conversations happening right now. Here is what Zane wants you to walk away with. The risks that dominate headlines and generate the most attention are usually already reflected in market prices to some degree. The risk that actually catches people off guard is typically the quiet one, the boring one, the one that doesn't make a compelling thumbnail. It has consistently been this way throughout financial history, and there is no particular reason to expect that pattern to change now. Understanding mechanisms like the yen carry trade and Japanese capital repatriation won't change what happens at the macro level, but it changes whether you're caught off guard by rising mortgage rates, stock market volatility, or tightening credit conditions, or whether you understand the structural forces behind them well before they show up in the headlines everyone else is reacting to. That's the entire purpose of this channel, shining a light on the unglamorous, difficult to clip, genuinely important financial mechanics that actually move the ground beneath your feet, long before mainstream coverage catches up. If this gave you a clearer picture of forces shaping your financial future that you were not tracking before, hit the like button and subscribe to Wetrix Invest right now, because understanding what's coming before everyone else does is the entire advantage this channel exists to give you.